Okay, thank you all for joining this today's sessions. We are going to update you about the market update today. Uh, what exactly is happening in the market, where we expect the market to go from here. You're going to get a brief about the entire details about the what all are happening in the market, so that you can take a informed decision about your investments. Uh, I have given a link in the chat box where you can apply for the next week sessions, which will be on a fundamental analysis final part. So to start with your today's sessions, we will be discussing about different aspects of market. So first couple of minutes, I will be showing you data, and afterwards we will interpret the data and suggest you what according to us is the best way to go ahead right now. Like like we all know that what exactly happened in the February and March, and it is one of the biggest economic crisis that we have faced, economic or the social crisis that every country has faced since the Great Depression. It is one of the biggest health crises in last 100 years. It's still going on. Greatest economic contractions in Great Depressions. We have the greatest central bank and government interventions ever happened, because we have never seen the government interventions of this lockdown and all those measures which are taken by the government of India and otherwise happened in the last 100 years and so. So it's a big event which has happened in the last 5-6 months, and so forth. And so we are going to show you some data. We'll be able to find out as of 3rd September. If you see the data, I have done an analysis between December 2007 to current level. So you can analyze the last 13-14 years where we exactly stand as far as the different ratios goes. So price earning, you all know what is the important indicators about the market. Price earning in December 2000, Nifty price earning was 22, and it is now currently at about 29. So price earning, PE ratio is definitely higher. Market cap to GDP in December it was 153. Now it is at 20.21. Now last 1 year, Nifty 50's earning growth was 3.3%. In December 2007, last 1 year it was 7.83%. In the last 5 years, we have an earning growth of 6.7%, where in 2007, prior to that, last 5 years was 22.3%. Capacity utilization of 68% now, vis-a-vis in 73% now. All the data apart from the P looks positive, but we have a negative GDP growth rate which has just come out. It is minus 23.90% to December 2007, which is a 9.60%. 10-year GSEC yield, which is a benchmark of debt funds or benchmark of fixed income, which is now at 5.9%, and it was earlier it was at 7.79%. Various other returns are given here below. So the data indicates that right now we are actually not cheap. Obviously, the market is not cheap because the PE is 29, near about 30. But we have a favorable market cap to GDP ratio, and the interest rate is also on a downward trend. So let's get some more data point. If you see the Nifty earning growth and return on equity, you can see the data from 2007 to 2020. Here the data is about. You can see that this is Nifty EPS, and whereas in 2019 it was it is extremely lower in EPS. And it is quite obvious because of what exactly happened in last 4-5 months. There is no business activity happening. If you see the Nifty valuation also, you can see the data wise, which has contracted in the month of April, obvious reason, and then it has grown up. So I will come to the analysis part in the later on. First, I'm going to show you the data point here so that you can understand that. And then I go to the a little bit segregation of what exactly happened in different industry. So if you see the different industry, I hope that everyone is able to see my presentation out here. If you're not able to see my presentation or my voice, you can write in your chat box in the left hand side, and I can fix the systems out for you. Okay. So if you do not write, I will presume that everything is viewable to you all. So if I coming back to the presentation, if I show the sector-wise data in the last 1 year, the mid cap has given 7.46%. We all know that what has happened in the pharma, it has given in last. It's an index performance in last 1 year. The pharma has given 40.48%. We have the bank, which has given 13.18%, And we have seen the different segregated performance in last 1 year. Real estate, we all know that is given minus 16% approximately. So these are the different segregation of industry-wise performances. So perhaps if you have invested in mutual funds or you have invested in shares, you know which sectors performance is your performance is actually dependent on the sector that you have invested into. If we see the Sensex and Nifty in the last 1 year, it has given 4% approximately. FI's investment right now it has increased. Last in the last MTT, which has seen that 42,821 CR FI has invested, but domestic investors has redeemed a lot in the last 1 or 2 months. So which is visible from the data also. If you see the monthly inflation data also, it is a year ago it was 3.15%. Inflation number has increased a little bit over the last 1 or 2 months. The reason because there is a lot of supply chain challenges which has happened across the India because of Corona incident, and also the production rate is lesser. We have seen the IIP data is also lesser right now. GDP, we all know the numbers which has come up last week. It is also lesser. So these are the data. I'm going to interpret later on, as I told earlier. So first 10 minutes I will show you the data only, so you can able to understand what's happening in the economy. Then I have segregated industry specific data for you. The red is bad, the blue part is watch, and yellow is neutral, and green is positive. Okay, so you can see the data. If you see the consumer data point, rural wage, you can see the data point, and different data point have given urban employment. uh, it has pretty much covered up in the month of August. Rural employment is a neutral space. We have motor vehicle sales, passenger vehicle sales, and all these things are in a negative. But one point, if you can see from the April to July and August, the data is improving. If it is 98 and it's 25, all the data point which you can analyze from the April point to the July August point, it is slightly improving. Obviously, it will not get green over right away, because what's happening, because economy is slowly opening up. So you will see all the data points are improving right now. If you see the major freight, you will see the foreign export grade, you will the fiscal numbers. So all data points from the March April onwards is improving. uh, if I go to the next slide, now I segregate into the banking and the industry specific. Banking, you can see obviously the numbers is in, or mostly are in green numbers. Personal credits, and if you can see the 10-year GSEC yield and every numbers are green. So if we go to the industry specific data, where is the cement production, if you see the numbers from March, April to June, July, the number has improved a little bit. If you see the steel production, it is minus 17%, which is minus 33%. So number is improving a little bit. IIP number has also improved a little bit. So even if it's all the numbers which you have seen, it is improved a little bit over the last, what exactly happened in March, April. So right now, couple of domestic newses. I skipped these informations. Now, if I go to the international sector, what we have seen that as per the US currency versus INR, the percentage change is like we are around about 73 currently right now. And if you see the commodity prices, if you see the crude prices, a year back it was like 60, now it is 45. Gold, which was a year back like 1500, it is now at 9, approximately 2000 level. Gold, and per 10 gram it's like 52,000, 51,000 level, which is a year back it was 38,000 level, so which has improved a bit. And if we see the global indexes, if you see the Nasdaq performances in last 1 year is 49%. It's like 50% return which is given in Nasdaq. This data is important. I will come back to this data once I do my interpretation part. And if you see the Nikkei, it has given 12% return. Apart from that, a couple of indexes which is negative. But Nasdaq, the major indexes in US, it is like a 50% return in last 1 year. So it has already been depicted out here. It is absolutely all-time high. If you see the data right now, in February, it was when the Corona outbreak happened. It was near about 9,700 level, and now it is near about 11,500 level. So it has a massive growth has been witnessed in the Nasdaq level in the last couple of months itself. Why this has happened, I'm going to tell you in time to come. Now we need to see that what exactly happened in India. If you see the FIIs inflow, like foreign investors inflow, I have already shown you a couple of data where we seen that in the month of August, domestic investors sell a lot, but what happened that FIIs and FII foreign investors have invested a huge amount in India, which is also been visible from this data. If you see in the March, when the market, we all know that the Sensex was at 42,000 level and it dropped down to 24,000 level. Even if the Nifty has dropped down to 7,500 level, 8,000 level from 12,000 in the March, you see the data of equity and debt. So if there was a huge outflow of FIs in the month of March, it continues in April also. But if you see from May onwards, we have seen a consistent inflow of FIs into the Indian equity market. We have seen it is gradually increasing in the Indian equity market. So I can give you a reason for that. Suppose अगर वो कहते हैं कि समंदर में एक जहाज जा रहा है, तो उसमें अगर एक there is one crow in the ocean, and अगर वो क्रो जहाज के ऊपर बैठता है और आप उसको भगा देते हो वहां से, उसको कहीं जाने का ऑप्शंस नहीं मिलता है, वो बार बार घूम के जहाज के पास ही आएगा. सो व्हाट एग्जैक्टली हैपेंड, दिस थिंग इज वेरी रिलेटेड टू द FIs. टुडे FI हैज टू कम बैक टू द इंडिया because there are no other options to go. Why there are no other options to go? In my subsequent data point, you will be able to find out. Market cap to GDP, what the histories tell us, in 2003, market cap to GDP was 48%. Next 1 year Nifty return was 11%. Next 3 year Nifty return is an absolute return 111%. So similarly, in 2008, market cap to GDP was 56%. And now next 1 year return was 76%, and next 3 year return was 113%. In June, market cap to GDP was 64%. You can analyze that what exactly is going to happen in Nifty in one year and next 3 years. Okay, this data is from Bloomberg data I'm gathered. Couple of more data points. Like in Jan 2020, the P, the Nifty P was 28, PB was 3.7, dividend yield was 1.2, and the market was at 12,000 level approximately. And we have the EPS of 430. Okay, currently it's a little bit old, 2 weeks back data. 19th August. This exactly what happened when the corona affected in India. 23rd March, we all know the lockdown started in India, and that was a P was 17. Market closes was 7,600. Index return was minus this thing, and then EPS was 443%. And currently, what we are having that its P is near about 30 approximately as of September, and we have market close to around 11,500, and we have an EPS of 340 approximately. So this is the data which we have. Now coming back to the debt funds, debt portion, that data what I have shown earlier is about equity portion in India, what is happening, India and global, what is happening. So coming back to the fixed instrument product, we have seen this is the bond yield. So government bond yield, this is the benchmark of any country right now, is this approximately. So in US it is yield is now 0.63%. So what that means is that if you are investing in a fixed instrument, fixed deposits or government bonds in US, you will get 0.63%. Like in India, in 10-year GSEC, this yield is 10-year GSEC is the benchmark parameter. So in India, it is around 5.82% right now. And if you can see the different countries' bond yield data, as I've shown you here, vis-a-vis a year back. So India, it's still much higher as far as the bond yield than other countries. Okay, so I move to another data point. Deposit rates, 3 months, 6 months, and repo rate. We have seen all have fallen down drastically. The 6 months deposit rate is currently about 3.89%, and similarly with the GSEC, the repo rate is around 4% right now. This is the number of data of debt funds category. The last data point, which then I will going to interpret about what I am going to say right now. We have this repo rate. Currently, it is 4%. It is 5.4. We have seen the interest rate reduction out here. So if you see the 1 year commercial paper rate, it is 4.65%, was 7 to 2% earlier. And 10-year GSEC, I said that 5.9% is currently, which was 6.56% a year back. And similarly, if you go with the fixed deposits instrument, like if you go for the 5-year fixed deposit rates, see the paper quality. The bank are normally giving 5.7%, which is a AAA rating, and government bonds are giving 5.22% in a 5-year, and 10-year is this rate. So this is the normal rate which has come up. So net, what the data has been saying is that in an equity front, the P is around 30, and the Nifty P is around 30, which is much higher than what we are actually 10 years back, or its 20 years average. If we see the interest rate, a government bond, which is 5.9%, it is on a lower trend. Uh, Market cap to GDP is also on a. If you see the market cap to GDP ratio, which is this is an important data point. Um, yeah. So market cap to GDP is like 64%. It's near about 70% right now. And if we see the earning yields, these three important parameters: P, market cap to GDP, and earning yields. Earning yields, how will you get? You have to divide this thing. 14,500 divided by 356 divided by 14.5%. So it's normally, how much will it come? I just calculate a little bit. 356 divided by 11,500, which is come around, see, 3% earning yields, which is coming up. So these are the data. Now to come back to the analysis part, what we are going to say that now what exactly happened in the last couple of months, like why market has grown up from the level what we are seeing. Let's get back to the developed economy like US, Japan, and Europe. What exactly happened? Where the GDP growth rate normally do not depict the real. Always a difference between financial economy and the real economy in those countries, and what exactly is going to be we are seeing right now here. So if you see the European market, the GDP data of the European market pre-corona era, they have a negative GDP growth rate. They have a flat. They have a negative interest rate all through. But if you see their Sensex, if you see their index performance is always on a double digit. Uh, so what exactly in a short run, you need to understand that GDP numbers do not actually reflect the market conditions, the financial market conditions. Why I'm going to tell you is that what happened in US is that in a short run, what happened that US economy, they have pumped in a lot of money in the last couple of months. In 2008 also, during the market recessions, they have pumped in a lot of money and revived the economy. And this time, in the last 4 to 5 months, US has pumped so much of money into the economy that they have not done in the last 50 to 60 years. But what exactly happened in US is that despite pumping in so much of money by the Fed, the interest rate in US has the inflation in US has not gone up. It is hovering around 1% right now, and that is one of the reason why you have seen the bond yields. The bond yields is directly proportional to the interest rate. Interest rate is bond yields is like 0.63% in US. So I want to ask you questions like, if you have money in your hand, and if you're going to invest the money, where will you invest? You invest in 0.63%. Okay, will you invest in 0%, like, or you invest in a market where the market has given, Nasdaq has given 40% or 50% return? I have shown you earlier in the data point, right? So where will you invest? The answer is obvious. The Nasdaq has been 50% in 1 year, where the FD rates, like the fixed instrument rate, the government yield bonds is about 0%. It's near 0%. Where will the answer is obvious, because which has been powered by the Apple, Facebook, Google, and other big brand companies, which has performed a bit. So what exactly has happened despite the Fed pumping in so much of money? Why the inflation has not gone up, and as a result, the bond yield has not gone up? Because people have, instead of buying food commodities, instead of buying on daily necessities, instead of buying on stuff that consumer durables and other, they have invested money in the bonds, invest money in the equity markets and gold. That is one of the reasons why gold prices soar up in the last couple of months, because there is a huge amount of money available in the market. And since the GDP is less, people have a fear that corona impact will last a longer, and they have invested money either in equity or in gold, right? So that is one of the reasons why the gold price has gone up. So that is one of the reason why the US and all the developed economy market has shooted up in the last couple of months, and exactly what happened in India also, because we have a lowering of the bond yields. Now, when we say that the fixed deposit rate is supposed, say for example 10%, now you have a PE, like PE, bond PE valuation of 10, right? So you have a bond PE valuation of 10. So I see a lot of people, they invest, they say that I want to go safe and invest in fixed instrument or government bonds or fixed deposit instead of equity. Like when we talk about these numbers, when we talk about the P, people don't have a clear idea about the P. When we talk about the 50, suppose the FD rate is 10%, so your P valuation in bond is 10. 100 divided by 10 is 10. So if your interest rate reduces, suppose the interest rate reduces to 5%, your PE valuations will go up to 20. Now, suppose the US bond yield is, suppose this is 1% example. So this P is 100. So the bond yield PE, so the bond valuation is 100. So why? So do you think that it is a good investment options to invest in a product where the PE is 100? People only look PE on the equity perspective. So if your interest rate is reducing, the fixed instrument become costlier. The PE increases. So that is the reason why people have gone back to the equity. Even if the equity is at 35 or 40 level, they have invested because the bond PE, that it has shooted up to 70, 80 or 100 levels. So that is one of the reasons why I've invested there. Similarly, thing has happened in India also. We have seen that government bonds has reduces to 5.9%. It is 6.3% a year back. So if it is reduces, the bond P valuation increases, which people normally don't take care. It is bond P valuation. If you see at 5.9%, it is approximately 19 to 20 right now. So that's what exactly happened. Secondly, there is a huge amount of liquidity available in the market. So money supply is huge. The bond yield is lesser. So people have invested huge amount in the market. So that is one of the reason why I'm saying that. And coming back to the point, so you understand the difference between the financial economy and the real economy. Why you are seeing that the market is at all-time high despite the GDP number are less and all the number are less. One thing I'm going to tell you is that I have shown you the data point from March, April data to July, August data. Things are improving. Obviously, the March data point are much worse, as I can show you earlier. Uh, just a minute. If you can see the data point in the March, April to July, August, it is improving in every aspects. Okay, so that's one data point is there. Whatever the GDP shrinkage has happened, which has happened because of GDP shrinkage has happened, which has happened because of already the corona has impacted the market, and what are the worst thing has already been in the past. Okay, so but what is going to happen in the days to come? Let's take that for example. Ah. So fundamentally, I have shown you that why financial economy is different from real economy. Like we normally tends to remain in the present, where the market is always in the future. Price versus value of money impact price and value of assets. And sentiments right now, either we have accepted and thus adapted to live with the virus, and we are close to therapy or a vaccine. So that's what exactly summarizing the market is all about right now. And couple of food for thoughts I'm going to give you is that whenever we see suppose we have buy a stocks and the stock price is 100 rupees, whenever they see the stock price has gone up to 200 rupees, we tend to sell it, right? But don't you think that the promoter of the company who have invested so much of money, so if your stock price is 100 and the stock price move to 200, why don't they sell off the entire thing? Because the promoter, the thinks in a completely different way than normally normally the people who invested a very small amount in a company. So equity investment for me, it's like, and I can suggest you is that you are a part of a company and not like you buying today and selling tomorrow. Like you, so you can able to understand where exactly the company will be going if you look at the promoter's participation in the company. So if a company's stock price move from, suppose say, for 100 to 200 as for example, and if you see how the promoters valuations and promoter part is out there, whether they are selling it, whether they are holding it, you can able to understand that kind of perception they have towards their own stocks. I have discussed the entire details about fundamental analysis in my other webinar. Next week, I'm also going to have a fundamental analysis so that you can understand how promoters behave in the stock price movements in that way. So that's number one. Three main important points that I will suggest you to look after before taking stock decisions. Okay, the three main important point. And if irrespective whether the market is at bottom, when should I get enter, when should I exit, you need to look at 3 points. That one is the PE. If the PE is below 20 years average, that's number one you have to watch out for. Second point is market cap to GDP. If the market cap to GDP is below 20-year average, that's second point. And third is the earning yields. Now, how will you get the earning yields? Earning yields I have shown you earlier is that Nifty, suppose we are taking Nifty, you can take individual stocks also. Nifty EPS, earning per share, divided by the Nifty, right? So that will give you an earning yield. So if your earning yields, okay, if your earning yield is less than the bond yields, so that is an indicator. So if these three parameters are below, irrespective of whether the market is GDP is going up, GDP is going down, you can buy up those stocks, right? So that has to go into individual stock parameter. If we see the Nifty also today, it is at 30 PE. But if you drill down to companies, you will able to find out that only 12 to 13 companies PE is driving the Nifty PE. The rest 35, 36 companies PE is actually much lesser. So there's a huge scope out there also. I have shown you the sector-wise performance also. So if you can see, I just wait, I go back to the sector performances. Just wait. Yeah. So if you see the sector performances here, another is that you see the bank. You know, the bank, normally the public sector bank and the big private sector bank, they account for 30% of Nifty. Now, in the last 1 year, the bank index has given minus 13% return. So imagine an index which is a 30% weightage in this particular sector, which is given minus 13% return in last 1 year, and you are going to know that next 4 to 5 years where this sector will perform. If you see the public sector, large public sector bank, they are not performed in the last 4 to 5 years. So if I'm going to show you a data point, like every industry is cyclical in nature. One industry which will not perform for 3 to 4 years will come up in the next cycle and will perform, and the other industry which has performed in current year will go back to the it will show the reverse performance in next couple of years. So what exactly happened? So imagine if the bank index started performing from now on, where the Nifty will go from here, and bank index is 30% market share out of it. Infrastructure as a sector, infrastructure does not only include reality. It has a cement, it has ferroalloys, and a lot of other sector. Infrastructure sector has not performed in the last 6 years. If you have invested in infrastructure funds, you have not performed there. So probably that's one of the biggest asset class to invest in that segment. So what my summary is that don't look after this Nifty and this PE. This P, Nifty P and all. So it will give you a very bad impression, because this Nifty P is all about first 13 to 14 companies. So if you drop down to the companies level, I give you 3 indicators of where to decide what to buy a stock specific. So if you buy on a stock specific in the next 4 to 5 years, you're going to make a huge money from out here. Wait. Now, to sum up and to give an industry specific viewpoint about what we think that going to happen in the days to come. Now, sector which we are very positive right now is large public sector bank and private bank. I've already given an example. Like there is a huge scope in large last 4 to 5 years, the sector has not performed, and probably next 3 to 4 years you will see a huge performance in this particular sector in large private and a large public sector bank. Pharmaceutical, if you see the PE right now, it's extremely high, and last 1 year it has given like 40 to 50% return as an index, pharmaceutical index. So it is will not be a wise idea to enter into a pharmaceutical. It would better if you have invested a little bit earlier time. So I will not recommend you to go for the pharmaceutical sector. Infrastructure, I am extremely bullish on infrastructure, but you have to wait for 5 to 6 years. This is a sector which has not performed in the last 6 to 7 years, and a sector which has not performed in last 6 to 7 years. It is bound to reflect. It is bound to come back. So if you have a little bit longer tenure, you can go ahead with picking up the right stock in the infrastructure segment. Metals, if I hope that there will a little bit of correction here, and also it looks very attractive. I will show you the data point out here. Wait for a little bit correction in the metal, and you can go ahead with that. Gold is always a fantastic asset class to invest into. I always say that whenever the market is not performing, we have seen the GDP has contracted. The corona cases right now, like in today, like when we are speaking right now in August, September, the corona is highest in India, and and we have seen there's a huge people are buying out in stocks and all. In the March, the corona was not at all there, so it's all about sentiments. You know, understand the sentiments work on a very short-term pattern. I mean, in a long run, only science matter, which is about EPS, which is about the PE ratio, which is about the company's fundamental. That actually works in a long run. So the short run, in the only sentiment works. So gold as an asset class, I will say it should be a part of an asset allocation, irrespective of whatever amount of investment you have in a total asset class. I always say that 5 to 10% of your total investment has to be in a gold, irrespective of time. It's an insurance of market, when equity doesn't perform, like obviously equity is performing, when the bond yields are coming down, when we have seen that there could be a potential war between US, India, China, the corona is going on increasing. When there is a lot of uncertainty there, people normally move towards the gold. So gold as an asset class is always a recommended investment, but it should not be a part of more than 10%. It's an asset allocation investment. And last point, I am saying that the next 12 to 18 months, you should definitely invest in a government bonds. You know, government bonds, as I show you the data, it has reduced, yields has reduced. So what happened that when the government bond yield reduces, the prices goes up. In the last 5 to 6 months, those who have invested in the government bonds, they have already given a huge return. They have already given a huge return in the government bonds. You have seen the 15 to 16 to 17% return in the government bonds in last 5 to 6 months. I have been already mentioning that. So I am still bullish on the government bonds, because if you see the yield curve, the government bond segment, like 5 to 9%, 5.8% government bond yields coming up. But if you see the AA segment, AA paper, government bond is like higher side. AA paper, it is still available at 9% or 10%. So it is this spread, like 5.9% to 10% level, has to reduce. When the yields of AA segment comes up, you know, the price will go up. So if you buy a medium term bond paper which has couple of amount of AA in it, you're going to get a double return from here from the next 6 months to 12 months. I don't see the interest rate going up from here, although the inflation number which I've shown you earlier, it's shooting up. Because what exactly happened that if you increase the interest rate right now, the real economy will not come up. You know, the corporates and the business community need funds right now, so the interest rate has to be on a lower side. But with so much money available into the market, and once this thing stabilizes, because a lot of people are investing in stocks right now, once this thing stabilizes, once the supply chain eases up, once this corona thing stabilizes, I think that there could be a little bit rise of inflation number which can boost up the interest rate. But that's not going to happen in next 12 before 12 months or 18 months. So in next 12 to 18 months, government bonds looks extremely attractive. Gold, if you do not have invested, to 10% of your total asset has to be in a gold. You buy an ETF funds, or buy a fund of funds, or buy a sovereign gold funds, but it should not be more than 10% of your entire portfolio. Rest of the sector I have already mentioned to you out here. So on a nutshell, if you ask me where the market is going to go from here, you have to only see the one number, that is an inflation number. So if you keep a tap of inflation number, US inflation, despite pumping in so much of money, it is still hovering around 1%. India inflation has increased a little bit. It is near about 5.67% right now, to be precise, if I remember correctly. So this has happened because of disruption in the supply chain and the corona factor, which has happened up. So if you see the inflation number is shooting up, then only the market can collapse from here. Okay, otherwise I don't see that there's a huge correction in market. There is no data point that is saying me, even if the Nifty PE, which is around 30 around, doesn't constitute the entire PE. It's like top 15, 16 companies, which are like 12 to 13 companies which are driving the PE. The entire segment is low, as I show you the data of specific industry wise. So there, I am not seeing a very deep correction from here. Whatever things has happened, it's in the past. Market always think about the future and react. We individual think about only the market at present. So market actually measures what is going to happen in next 1 year and 2 years. We all know that we have somehow been able to understand what the corona impact is all about, and that's why I'm going to tell you that sentiments, we have already close to therapy or vaccine. And so in the next 1 or 2 years, I don't see a very deep correction from market out here, which I was actually saying in 2 months back. That could be a possibility, but with vaccines coming up faster and inflation number in control, okay, so I don't think so. But only two things you need to watch out for. One is an inflation number. If it is shoots up, if the government do not able to manage the inflation number well, there could be a potential that market can collapse. You don't see any of the numbers. And secondly, if you want to pick up stocks, if you invest, I have given you 3-pointer: PE, market cap to GDP, and earning yields. You can look up for the individuals, look up for the benchmark index or whatever you want to invest in. Those are the two things which you can look out for and go for investments. If you have a 5 to 6 years of 10 year of investment duration, I don't think so. It is you don't have to worry about anything, because equity is a long-term investments. For individual stock specific, I mentioned you 3 point plus promoters holding, which I've already told you earlier. Like if the promoter, the price is 100 rupees, it has gone up to 200. Why the promoter is not selling? Because they have invested huge amount. They can easily pump out the money and go out. So why they're not selling? Why it is only individual? Like I've invested 1 lakh, my value become 2 lakh, I come out of the market. Why it's like that? Why the promoter who have invested like thousands of crore, they are not coming out at 2,000 crore, because they make 100,000 crore profit. Why they're not coming out? So those are the factors that need to be looked into. I discuss the entire details out in my fundamental analysis out there. So that's what is all about. So on a summary, I can only say that probably in a shorter duration, shorter span, it is very difficult to predict, but I don't see a very deep correction from out here. It's not possible. If and otherwise we somehow do not able to manage inflation number well, because if the inflation number goes up, interest rate is going to go up, and if the interest rate is going to go up, then this is a deep impact in the market. And that exactly what happened in Japan. Like if you see the Japan stock market index, if you see the trend in Japan stock market in the last 50 years, they have fallen down because they have a sharp increase in inflation rate in between, and they are not able to recover from there. So I don't think so the inflation number will go out from here. So that's what for me is all about. And you can drop me a questions. I already overshot 10 minutes of time of my 30 minutes time. So if you have any questions, you can drop me personally. I can answer you out there.